Good mid-morning, I guess. Now seems how we're doing a little bit different time for 30 Minutes with the Realtor. I'm Andrea Lane, Realtor with Berkshire Hathaway Home Services, Ambassador Real Estate. And I am joined by the lovely, on the other side of my tree, Francisco Serrana, as is in the notes. And these videos are on Facebook forever and ever, and you can come back and rewatch and giggle with us and have a good time. So the month of January, I promised we would be doing a video every week to kind of make up for some of the time last year that I didn't get my videos. But so for this year, because my daughter's in preschool, I'm doing these videos on Wednesdays, and we changed the time to 11:30, just so that everybody can kind of get a chance to do this during their lunch hour, ask the questions that they want to ask, and then kind of see the stuff that we're going to be talking about. And a lot of fun shows. I'm sure we'll probably have Francisco back again as we get like mid-year, talking on some stuff. I'm sure, maybe you'll have to pop in next week. I'm dragging Michael Severe in to talk about places to go and eat. So, so I wanted to do this when we talked a little bit about doing this ahead for talking about the state of the market.
Right.
I think one of the biggest things I call you on right now is everybody wants to know, like, hey, where are rates at? What are rates doing? So let's talk about that a little bit.
This is the thing. Rates are interesting because I always tell people when they ask me, is it no matter where the market's at, they'll ask, is it a good rate? Yes. This is why. We kind of know what the market will do, because if the Fed says they're going to ease off of buying mortgage-backed securities, that tells us that rates are going to go up slightly.
Okay.
Right now, rates are in the 3s. Now, last year...
This is sort of like 3. What was conventional?
Conventional 3.375, 3.25, somewhere around there.
Okay.
Don't compare it to last year. Last year was good. The year before was even better when it came to refis. Rates were at an all-time low 2 years ago. They were in the low 2s.
Right.
Although we won't see that for a while.
Okay.
3s are still good.
No. And I think this is what people forget. Is like, we should put a big star.
Yes, they're still good.
This is
yes,
still good.
They are good. Now, the tricky part is going to be the Fed has promised to raise the rates three more times.
Okay.
From now until March.
What? Before March?
Yeah.
Okay, so I'm going to put this up. It's going up.
Now, what will happen, though, is banks have already put some of those jumps in the pricing now.
Okay.
So it's not going to be crazy. It's more of a warning.
Okay.
That the artificial low rates, because if the Fed's buying the mortgage-backed securities, they're keeping the rates low on purpose. That's going to come to an end. And to me, that's a sign of, if you're on the fence, if you've been thinking about refinancing to take money out to remodel or to purchase, the time is now. One thing I will tell people, I have a friend, and I have some friends actually, who I've refinanced where they have, maybe they had a 2.5% rate before, and I got them to do a 3 or 3.125. Why would you go into a higher rate? Cash out refinances, what you do is you're eliminating a lot of that monthly debt. It saves you $500-600 or more.
Right, because you're taking away that rotating debt that you have every month. Correct. Even though the interest on your home loan goes up ever.
Correct.
The percentages.
Yeah. So don't necessarily think about it in terms of, I need the lowest rate possible. Sometimes getting a slightly higher rate is in your best interest only because it eliminates that installment debt, NFM, credit cards. We all know, even if you have the best of the best credit, that APR is 18, 17, 19, 20%. You can't beat a 3% loan.
Right, even at
3 and change.
Even at 4. Even at 4, you're still doing better than the credit card.
Exactly. So it's you've got to, it's obviously you want the lowest rate possible. I don't care who you are, you're always going to think that. But sometimes it makes sense when you're wanting to eliminate debt. Now, one thing I run into a lot, I do a lot of loans for Spanish-speaking individuals, and you'd be surprised how many people have relatives that have 0 to 1% rates. They want to one-up you. Don't fall into that trap. This is why.
And what you're saying is, where you say, oh, hey, I got a
I got a 3% rate.
3.375. And they're like, oh, well, I got a 2.75.
Exactly. First of all, everyone's credit's different. How much you borrow is going to be different. And more than likely, it's going to cause a panic and or a delay to where rates can go up even further because you chose not to act because someone got a better deal somewhere else. Um, Everything is specific. Your credit, the way you use it, your score, your debt to income, how much you're borrowing, all that comes into play when you're borrowing money from a bank. So, not everyone's situation is identical. More than likely, you're getting the best deal available. Jump on it before the rates go up.
So, and let's kind of go back to that because I feel like there's been a lot of talk recently about like what goes into, your credit score. And I think one of the biggest things that, or not just your credit score, your rate, what you're getting for this interest rate that's up here there, because they see a commercial or an ad on Facebook and they're like, yeah, but this ad on Facebook says I can get blah, blah, blah.
Right.
And they forget to take into account that it's looking at, so we'll break down really quickly. Your debt to income means what you're spending to what income you have coming in. So if you're salaried and your salary is $60,000 a year and your monthly take from that is $3,000. 5,000. So 5,000, but you're looking at a mortgage that would be 2,000. You're already at almost a 50%
right
debt to income ratio.
Right. And that doesn't include, we take into consideration any car payments, credit cards, student loan debt. All that gets factored into your ratio, depending on how low that is. So, for example, a conventional. Typically, they want to see you at a 45% or less. We can go up to 50. That's the max on conventional. FHA will let you go to 55.9, just a hair over 56 sometimes. VA, a little bit more tricky. I've seen them go as high as 60-something%, but it all depends on compensating factors.
Right. So do they have car payments or all the cars paid off?
Correct.
Do they have like 12 credit cards or they only have like 2?
Right.
And then what's the balance on those also? Because I think that's the other thing people forget. They're like, well, I only have 2 credit cards. I'm like, yeah, but your max balance is 8,000 and your current is
at
like 7,500. Yeah.
Right.
And so you're really high on that credit card. So they look at the opportunity there that you could maybe default or have a late payment.
Well, what it does is it takes into consideration a few things. How much credit you have available, how many credit cards you have open, how much open you have. So let's say from what you said, if you have an $8,000 credit limit and you use 7 and it's consistent on all those, it dings you. How long you've had them open, if you've made the payments on time, all those factor into what your score is going to be. I see it time and time again where someone has kind of a lower score, but they have no lates. What that means is they're using a large percentage of the credit that they have available. And what happens is the agencies, they've been doing it for so long, they see a pattern. If you have 4 credit cards and no lates, but they're all pretty much maxed, chances are when you get offered a 5th or 6th card, you're going to max that out as well. They put that in their formula.
Okay.
So it's very important to keep now for your sake, because I don't know about you, but in my younger days, I remember feeling like I was in quicksand when got a credit card. Oh, you go out with the boys, you go out with the girls, or you buy that whatever, and you max out those cards. You know how difficult it is to get that back to a normal level or back to a level where you're like, okay, I can kind of see the light of day.
Right.
That interest kicks your butt.
Right.
That's why a cash out refinance may make sense, even if it's at a slightly higher rate, because you get to eliminate that high APR. Right. You get that headache off of your plate, and it just makes good financial sense sometimes.
Right. To pay down some of those because you're paying a couple of them,
Correct.
And especially if it's student loans and so forth, because I know you guys factor those a little differently because a student loan doesn't quite hit your credit like a credit card.
Correct.
Does, because they're not like, oh, hey, they decided to go shopping. I mean, you went shopping for your education, which is a little different.
Right. So what happens is we use a percentage. So depending on what program you're in, conventional, FHA, or VA, there's certain formulas that we use to count that debt against you. I believe the student loan companies did another year's worth of you not having to make a payment. There's a specific verbiage for it that I can't think of at the moment. So right now, people
So they're
are
giving a
making
little
payments.
ease on having to have payments due to COVID.
Yes, this
Okay.
is the challenge though. Although you don't have a payment, you're still paying interest. That interest
Still
is
accrues.
accumulating. So it's one of those things where yes, you may have a little bit of a break when it comes to making that payment.
Right.
But remember, you don't get something for nothing. You're always
wait,
going
I'm
to
make
pay
you say
something.
that one more time. Say that one more time.
You don't get something for nothing.
There's nothing free. The
No.
TV wasn't free when you bought the car.
No, it just there's always. I don't care who you are. It's if they're in the business of making money off of you, which credit card companies, student loan companies, that's one thing you and I have talked about before. One of the things that infuriates me more than anything is at 18 years old, it's almost impossible for you to get a $10,000 business loan, but they will saddle you with $100,000 in debt like this.
Right.
There's something wrong with that philosophy.
Right, because they won't let you run a business, but they'll let you go to college and get
for $100 grand.
Yeah.
So now we're getting off topic, but think about that for 1 second, where they'll saddle you with debt. And the thing is this: in order to have a good credit score, because when you have a good credit score, you will get the best terms.
Right.
You have to saddle on some debt. So it's a double-edged sword. And the one thing you've got to do is you've got to be responsible and mindful. Now, I'm not a fool. When I was younger, I wasn't as mindful.
Sure.
I wasn't as disciplined. So you've got to really think through not only what's going on right now, but 5 and 10 years in the future.
So would you say that with also maybe the stay where you're at or move or doing some of those items, like where are you?
How do you mean?
So when you say when you're thinking about 5-10 years,
mm-hmm.
So some of it I say is, hey, if you're going to be in Omaha, if you're going to be working here in 5-10 years.
I was talking about debt.
Debt-wise.
Yeah.
Okay, so is in 5 years, will I have this paid off? Will I have that paid off? What can I have paid down?
Right. And things happen. You're going to need a newer car.
Right.
You're going to need, you take family vacations. You want to enjoy your life. You just want to be mindful as to how you use your credit and know that credit isn't just there just to buy anything you want. There should be a madness. There should be a purpose to the madness in terms of how you're using your credit. And you want to put money away.
And I think sometimes people don't realize that how much of your transaction this credit score affects. It affects this APR rate here, mm-hmm. which in turn affects your monthly payment,
right?
Which affects when you go to apply for insurance for that house, because they're looking at that same credit score for your insurance to give you the rate on that. So if you're not at the maximum score, then you won't get
maximum pricing.
The best rates.
Right.
And I think sometimes people forget. They just see what's listed on a website and they automatically assume, oh, hey, if I go to this place, this is the rate I'm going to get in.
Right.
And you're not. Right. But there's also things we can do, which we've talked about, ways to improve like your credit score as far as consolidating the debt down, finding out what you can pay faster, knowing which ones have higher interest rates so that you're not caught on
those first. Right. And what you want to do is, let's say you don't need 3 credit cards, you want 1. Sometimes it's a little better to have 1 or 2 more lines open. Don't use them. Pay that yearly fee. I know it's a BS thing where people don't want to pay it. Even if you're not using it and you have a big balance or a big credit line available to you, it still serves a purpose because every month it's reporting that basically I have good discipline. So I've got access to all this credit and I'm not using it. So it does serve a purpose.
So kind of going to that. So when we talk about these good rates, I was always instructed that you should have at least 2 lines of credit mm-hmm. at any given time. So mm-hmm. like to not completely close them out and just be down to 1 is to have. So like what you're saying is if you have 2 credit cards, keep at least both of those open, even if you're not using the one, because you're saying the credit institutions are looking at that and they're saying, so if you got into that pickle, like you said, hey, I got a flat tire and I need to put it on, a monthly payment, I could because I have access to that. So would you agree, like roughly 2 credit cards?
2 to 3. And I know that sounds foolish because the whole point is to keep them open and keep them low.
Okay.
But you want to show that you have the discipline to where, let's say you have $20,000 amongst 3 cards in available credit and you're using 2 to 3,000. That shows phenomenal discipline, and that score is going to just keep going up.
Keep going up.
Right.
Okay. So we talked a little bit about the market going up in the next, by March that they're going to see that. And I know you and I have talked about it, but I think everybody kind of gets that panic that all of a sudden we're going to see rates like at 8%.
No.
And I'm like, no, it's going to go up, but it's not going to be like crazy. Because I've even had some people when, like for VA, it's at a 3% right now.
Right.
And they're like, oh, well, I want 2.75, which you can buy down get a 2.75.
You can.
But points on a loan have always been one of those weird things to me, is that it's not really buying a point, it's a percentage, and that percentage is really only like a quarter of a point. So to go from a 3 to that 2.75 is 1 point. And that's roughly about 1% of the loan amount. So if you're at a $250,000 loan, to get it from a 2.7 or from a 3% to a 2.75, you're going to be paying $2,500.
Right. And what you want to do is you want to make sure that the value is there. Value is the key word when buying anything down. Right now, it would make a little bit of sense to buy points down because the likelihood of the rates going down anytime soon aren't there. So it would make sense to do it right now.
Right, but we've talked about this too. And the other thing is you got to look not just, is it beneficial to buy the rate down, but how long are you going to be in the house?
That's key. Because I used to do a lot of loans for executives at ConAgra who would be in the area 2 to 3 to 4 years. May not make sense because you may not recoup your money.
Right.
Now, that's where more out-of-the-box loan types come into play. 2 to 3 year ARMs, 5-year ARMs. If you know that you're not going to be in a certain area for a long period of time, different financing may come into play, but you've got to ask yourself those questions. Am I going to start a family soon? Like if you're a bachelor or a bachelorette and you buy a 2-bedroom, 1-bath home, do you see yourself starting a family in the next few years? You got to ask yourself a few questions, only because you want to make sure that you're getting the value out of it. Now, sometimes we can't control life. Sometimes it's a whirlwind romance. You meet someone, you have a few kids, or you move or whatever. You can't you can't always predict the future, but you know yourself. You want to make sure that you at least ask yourself those questions. Is this a long-term home? Is this a starter home? Where do I see myself? Just so you don't foolishly spend your money.
Right.
For lack of a better term.
Well, and it's interesting because you said a word that I think most everybody hears and immediately, it's kind of like the big E is the ARM. Right. Is that people forget that it isn't a bad product if it serves the purpose for the time that you're there.
Correct.
So like you can do a VA ARM if you know you're only going to be stationed here 2 years or 3 years. So you want the lower payment over having another product.
Right.
Is that, you're going to be here 3 years. In 3 years, you sell it, you make your money off of it, but you had a lower interest rate and you were able to maybe pay more towards the principle of that. So I think that's interesting to hear you say that, because I think sometimes people forget that there's a whole lot of product out there.
Yes.
I had an agent recently who had no idea that you could do a VA NIFA. And NIFA being that in a traditional loan, they help you with your down payment. In a VA, they'll help you with your closing costs, because right now, being a seller's market, not as easy. But I think, market-wise, that's still an advantage for people that are out there looking, is that that you have that additional opportunity for different loan programs and having a lower rate.
Right.
But we're not going to see, like, if conventional is 3 and I think VA was like at a 3%, it's not going to be like 8% by March.
No.
Like they're not jumping it up that much. So you're not going to see.
I think we'll flirt with the 4s, maybe 4-ish, but I don't think it would go over that. Now, at the end of the day, there's a forecaster I follow who says sometimes we're right, the market's always right. So it's just a matter of staying on top of it, just kind of keeping your ear to the what would I say, to the wall, to whatever. If you all of a sudden start hearing, rates are 4s and they're starting to keep going up, then at that point you just want to make sure you're understanding what the market's doing.
Do you think? So I know, like, everybody, I think that's kind of what's pushed everybody out right now, wanting to search for homes, is that fear that the rate's going to go up. Which is interesting because what was the rate of your first house? Do you remember your interest rate?
I did a NIFA. I want to say I was at 7 and change, maybe 7.5.
So I did a NIFA also. My first was 9.
Yeah.
So I laugh when people are like, it's a 3.5. And I'm like, 3.5?
Yeah. It's still cheap money.
Right.
It's still cheap money. My parents bought in 87. It was like 19 and a quarter.
Oof.
That's a lot of money. That's a lot of rate. But back then, they did, I want to say 20% down.
Right.
So times have changed. You don't need 20% down. Now, obviously, the more equity you can, the more you put down, either you have no MI or lower MI. With the VA, you never have MI. It's just a matter of you being comfortable with that payment.
Right.
Because MI does make a difference. And the better credit you have, the lower that MI is.
Okay, so I guess that was one of the things I didn't realize.
Mhm.
So if you, the better your credit score is, it's not only your APR that's going to be better, but also your MI. So your mortgage insurance, which is the insurance
Correct.
because you're not putting
20%
down.
And also the program that you're in. So let's say you do it. What are the twofold benefits to NIFA is, let's say you do a conventional NIFA, either the down payment assistance, the HBA, or the regular. Not only are you getting a better rate, but also on first-time homebuyer programs, NIFA has a deal worked out with the MI companies. You get even lower MI at that point. If you do a home ready or a home possible, which is another first-time homebuyer option for conventional, the rates for MI are lower. So really, credit score and programs make a big difference. Now, the one thing I get asked a lot, and I don't blame individuals for asking, if I've owned a home and I'm not eligible for NIFA, are there any kind of breaks or is there any kind of anything? No, there are not. And also, if you make too much for a NIFA or for a home ready or home possible, are there any other things? Most, I would say 99.9% of any programs out there are income related. So if you make too much for NIFA, if you make too much for what have you, you're going to make too much for anything else. So that's a matter of having some discipline and putting some money away, because on paper, now, and when I say this, I'm saying with a grain of salt, we use your gross monthly income. We all know the tax man comes around.
Yeah.
We all know that you've got to buy groceries and utilities and things of that nature. So it's a double-edged sword. Yes, you're making more money. Yes, it gets you out of the first-time homebuyer options, but there are still options for you. We could do a 3% conventional if you're not a first-time homebuyer. So there are FHA is 3.5% down. VA is always 100% financing. There are options for you if you're not a first-time homebuyer.
I think sometimes too, there's a little bit of the changes for FHA that have really pushed people into the varied conventional products, which being that MI does not drop off on an FHA,
correct,
even if you hit that 20% mark.
Right. And
that I would even encourage people that if you purchased FHA within the last 2 years, you may be able to refinance
into a conventional
because of the increases in the market, you may have your 20% equity, and that MI would completely drop off anyway.
And NIFA, if you've done NIFA in the past few years, with the values keep going up, fortunately enough, in our area, we can give you a lower rate, maybe get rid of your MI, but definitely get rid of that HUBA. It's going to save you money all the way around.
Right, which then could maybe be applied to something else that's like a rotating charge for you. Kind of the Dave Ramsey approach of pay this off, apply it to something else, and then be able to do something with it. So yeah. So that, I think it's interesting. I like that we, have this chance to kind of talk about where the state of the market is, because I think everybody thought, with rates increasing, where am I going to be at? How's that going to affect me? Is it going to be really negative? Do you think with the rates going up, you'll see a slowdown in the market, or do you think that some of these people who, want to purchase a house are going to purchase even if it's 3% or 4%?
In our area, I feel it's always going to be consistent with how busy we are because of because of the lack of inventory.
Right.
If we had more inventory, I think we'd see more of a struggle. But unfortunately, we are so low in how many homes compared to how many people are looking. I don't feel that we're going to be in too much danger around here. And that's also beneficial where whenever you see any kind of small crashes on the East Coast or the West Coast, we're pretty well protected around here because our values, because of our low inventory, it's just there's always a demand. Now, new construction is definitely where I see the trend kind of hitting around here because there aren't too many homes available. I mean,
Yeah.
how many active homes are in the on the market right now in the Omaha metro?
Oh shoot, there's probably maybe 1,500. I mean, it's
What would be a healthy amount?
3,000.
So I read somewhere, and you correct me if I'm wrong, because you would know, you're the expert in this area. I read somewhere that we are the same size city as Indianapolis, Indiana, and they have anywhere between 6 and 7,000 homes on the market at any given point. So if we're at 1,500, and I mean, I think a few months ago, I'm almost positive I heard someone say that we had 600 to 800. That is so low.
Right.
I mean, there are hundreds of thousands of people in this area. So if you have that small group of homes, it's a free for all.
It's like I say, it's like playing musical chairs.
Yeah.
And there's 2 chairs, but there's like 10 people playing. And so like that's what it's, that's right. how it right. goes. And so to me, I think like your rate is probably, to me, the lowest concern. Like number one is having your closing costs.
Right.
And having closing costs in your account.
Mm-hmm.
Because closing costs have to be in your account 2 weeks prior, correct?
It's you and I have gone through this. You want to have it in there as early as possible. Now, if let's say you've requested a 401k loan or you're getting a gift, as a lender, it's foolish to not know what that plan is if they don't have it in their account at the moment. You want things to already be in the works, because what you don't want is to be delayed for closing because something didn't happen or something didn't work out. So then at that point, everyone has egg on their face because the plan didn't go as desired. So you want to make sure that, yes, I mean, the earlier the better. And hopefully there's a pretty good plan instead of I get paid. Like I have people that'll say, I get paid the day before or the day that we close. Can I use those funds? At that point, we've got to extend the closing because the underwriter has to verify those funds. We need to make sure that it matches up with your pay stub. And you'd be surprised how many people in this area, or how many people pretty much anywhere, have a ton of cash at home. Cash is the devil when it comes to funds to close. If it can't be verified, we can't use it. And you can have $100,000 underneath your mattress. If we cannot source those funds, we can't use a dollar of it. So
I just had my first crypto closing.
Ooh.
Yeah, that was. I don't know that I'd recommend it because I feel like, to me, crypto is almost like having cash, is that you have to have that trace of where it came from. Yeah. And although we joke about it, it is truth. Like they want to make sure you're not a terrorist. They want to make sure you're not being
funded by the illegal activity.
Right. You're not a drug dealer and so forth. Like they want to be able to prove that you got money honestly from an honest trade. And I feel like that's kind of how crypto was. And I think as time goes by and more people are doing it, I think it'll be a little more fluid.
Yes.
But I also had a really rough underwriter who kept asking for statements from the crypto account.
And that's because it's so new.
Right.
You want to make sure, because the scary thing with anything that's brand new is what's the legitimacy of it? You just want to make sure that you're covering your bases, because we all, and when I say that in the mortgage community, have to ultimately sell our loans to Fannie or to Freddie. We want to make sure that we have a sellable loan. That's why. They just want to make sure that they have all their I's dotted and all their T's crossed, because ultimately you don't want that loan sitting on your books.
Sure. Well, and that's, to me, that's always been why the VA loans are so lucrative, is on the secondary market. Those things are going like,
Mm-hmm. And don't fall, one of the things that I see, and it doesn't matter if it's a nationwide company or local. I hate when a veteran calls me and they'll say, yeah, this nationwide company offered me X amount of rate. And I'm like, I'm nowhere close. So make sure that there aren't a ton of points attached to it. You'd be surprised how many people take advantage of government programs because there's more in it for the lender. You just want to make sure that you get a few quotes just to keep everyone honest.
Sure.
And sometimes, like I said, points do make sense. but not to the extent where you're paying a few $1,000 where you can get the same rate or lower for free somewhere else.
Right, which we had. You and I had one that was like that, where it was like, I'm sorry, I always say, hey, make sure you tell them you're not paying any points with me. And I think it's because as a consumer, they don't realize the higher the interest rate, the higher the commission that loan officer makes.
Correct.
So it's not in, you don't want to say it's not in their benefit to give you a great deal, but at the same time, you want somebody that is looking out for you, I guess.
Correct. And that, and I'm one of those people who believe in staying local, because I my branch is in Omaha. You can come visit me. We're not hiding behind a few different operators or a few different what have yous. Just make sure you do your due diligence and make sure. Now, again, people do have varying rates, but typically they're pretty close. And before anything else, you want to see their best foot forward. And that's, what's my rate without any points? Like if I walk in off the street, this is my credit score, this is how much I'm borrowing. What's your best rate? So that's where you want to be.
And I had one of those recently where they said, they quoted me 2.75, and that was what we were going to get. And I said, well, you can't lock your rate until you have a contract.
You have to have a home, correct?
And I said, so, and then it varies, because we've seen some where like on Friday it's a 2.75, and then by Monday it's
3 change.
Right.
Yeah.
So, that made me nervous, because like what you said, I'm worried that they're already like pre-selling them on buying points, and that it's going to be.
And sometimes, and I always hope that people are doing it for the right reasons. But what you want is, you want to make sure that the excitement stays with your person. Sometimes it's difficult, but you got to do it. Where I had a young lady where she cannot find a home. She's been trying for a very long time, her and her realtor. When we first started, her rate was at 2.875. As of yesterday, the market's just increased to where she's at 3.625 today.
Oh, wow.
Now, she isn't waiting purposely. Just there's nothing in she's a very specific area with a specific
price point.
Correct.
Mm-hmm.
So that market's just crept up, and fortunately enough, her and I communicate on a weekly basis, so she's known the little increments, and at this point, we're just waiting for that house the unicorn to be there.
And what's interesting is we're not the only market that's like this. There are some better than us, and obviously there's some worse than us.
Right.
But we just gotta, I guess, the market isn't as bad as here, mm-hmm. as what you see on that national level. Right. And I guess that was kind of my big point in sitting down, giving some of this information today, talking about some of these things that I know we talk about it, and we'll talk about again, and we talk about again, because some things don't change. But at the end of the day, like our rates, buying points, again, look at whether or not you're going to be in the home longer than that 2 to 4 years. If you know that you are, then pay your points and buy your rate.
Your mortgage loan officer should be asking you those questions, only because we want to make sure we know everything possible, not to be intrusive, but to, first of all, to make sure that we have you in the right program. Ultimately, without wanting to, we as lenders will find out things that you maybe didn't tell us on purpose or didn't want us to know. We end up finding out. It's easier if we know that stuff up front, just to make that transaction a little bit easier. One of the things, and my better half and I were talking about this the other day, you'd be amazed how many people from different countries, and mostly males, that will ask me, or I'll ask, are you married? And I'll say, well, I'm married in my home country. Does that mean that I'm married here? And I'll say, ask your wife. Get it, whatever her response is. That's what, if you're married somewhere else, you're married. So it just little things like that, where that's always kind of a little bit of a red flag. Because at that point, I'm asking myself, what else do they not want to tell me?
Right.
And and it's not, again, not to be intrusive, but depending on the program. Now, there are some programs, it doesn't matter how much you earn. There are some programs where
what you earn is everything.
It doesn't matter. But if it's a first-time home buyer program, it's going to play into account what we can offer you depending on what your spouse earns and things of that nature. Where if you're married and they live in a foreign country or they're visiting and they're not going to be here for closing, we need to arrange the proper documentation for you to be able to close. Yep. So it's just things like
that. The embassy. We've had that. The embassy.
You and I had a deal where they had to find the person on the field in Europe or Russia, or it was just the little things like that, though.
It was an island, because you said without a doubt the embassy is always on the opposite side of where they are.
You have to have, so if we do a power of attorney, we always have to have that power of attorney signed by a U.S. notary, meaning you've got to go to the U.S. embassy. 9.5 times out of 10, I don't care what country it is, whoever I'm speaking to, they will always tell me that the embassy is on the other side of where they're at. And it doesn't matter who it is, year after year, time after time, you'd be amazed. No one lives on the same side as the embassy. I don't care what country they're in.
We may have to talk about that on another 30 minutes with the realtor. That's the fun of this, is there's always stuff to talk about. There's always topics. And I hope that you will message me or put it on the Facebook page where you can find this at any time. Some of the things that, if we bring Francisco back, you want to talk about from the loan world. And I know one of the things I'm learning more about is commercial loans. So we may even have to talk about some of the business and commercial loans that are out there. So thanks for joining us for 30 minutes with a realtor. This is Francisco Serrano with Charter West Bank. I thank him so much for joining me today.
Thank you very much for
and we will see you back here for 30 minutes with a realtor
Have a great day.
next week.
So did that post live?
Mm-hmm.
All right.